Neil, we have a retirement question.
Alrighty.
So, what's the difference retirement accounts that we can contribute to impact the taxes?
There's a bunch. So let's see. The most common ones that you'll hear about are an IRA, which is an individual retirement arrangement. Actually, does not sound for the A does not sound for account. There's 401ks, there's 403bs, there's simple IRAs, there's SEPs, Simplified Employee Pension Plan. There's a couple other the code sections for. And then there's a whole other beast called a QRP. So I'll talk about that one first for a second. A QRP is basically a qualified retirement plan, but it is much more powerful than the other things. Like because like a 401k in 2024, the maximum you can contribute between you as an employee and your employer doing matching is $69,000. A QRP is like $270,000. So it's four times more powerful. The problem with QRPs is that they tie into actuarial calculations. And so generally you have to pay into them for at least 7 years at high levels in order to be able to use them because it's getting too technical, but basically you want to avoid creating a modified endowment contract because you lose the tax deductibility of things and the tax-free growth. If you have a super high income that is reliable for a long period of time, then QRPs become viable. For everybody else, which is the vast majority, then the uh, then the more standard ones, the 401ks and all that kind of stuff, are applicable. As far as which one to use, it's going to depend on your business structure and it's going to depend on your numbers. Most of the time, 90+% of the time, the most efficient thing to do is to use a 401k. And that's because you get contributions from the employee and the employer side. The employer side is limited as 1/4 of the wages paid. And so an SEP has the same 1/4 limitation, but there's no employee contribution. So you're just stuck with 1/4 of the wage and you can't kick in on the employee side. 401k, you get 1/4 of the wage plus the employee contribution. So you get to hit them more efficiently than with SEPs. Like I said, most of the time, 401k is going to be the way to go. IRA is going to be a lesser version. I think the limit this year is 7,500, maybe. Changes a little bit every year. Might be eight
Yep, it's
grand.
7,500. No, it's
Okay,
7,500. Yeah.
great, great. That is not tied to your W-2. It's just a separate deduction, and whether it's deductible or not depends on how much you make and whether you have employment or you have retirement options from your employment. But by and large, that is viable. Also, question then becomes, do you want to do traditional where you get the tax deduction? And we talked about earlier how you have all the issues with the deduction now versus the income later, or do you want to do a Roth version and you take the tax hit now for a tax-free um, benefit later? So I will warn you that here's my tinfoil hat thing. Now, I'm not saying this is likely, but I am saying this is possible. There is the possibility that as the government gets broker and broker, then there's the amount of money that's in retirement plans is roughly equal to the 30 something trillion dollars. So there's this enormous temptation for Congress to go in and just take that money. So I'm not saying it will happen, but I'm saying it did happen in Poland. And that was in 2010, something like that. So Poland had a different retirement plan structure, but roughly similar. And one morning, and they always do these things on the weekend, but one morning, Monday, everybody woke up and all of their retirement investments were replaced with government bonds, dollar for dollar. So if you had 100,000 uh, zloty or whatever the Polish currency is of investments in your retirement account, you woke up with 100,000, same dollar, same currency amount of government bonds. And the government said, "Thank you very much. We did not shortchange you at all because dollar for dollar or zloty for zloty, it was equal. But now you're making 2% on your own bond rather than investing in whatever investments that you had." So in my darkest days, that's what I worry about when it comes to retirement plans because all of these things are created by Congress. They can all be changed by Congress, and they have been various different rules. They could take away the whole thing potentially. I don't think that would happen, but the government bond swap, I think, is viable, and it worries me. But the chances are low. because the political backlash would be unbelievable. But, it's within the realm of possibility.
Understood.
Hopefully it's
Yeah.
not too scary, but.